Hi there, this is Alvin from Dr. Alf. Today I'm going to share with you 3 ETFs that actually took Warren Buffett's advice and made higher returns than Warren Buffett himself. One of the popular advice that Warren Buffett has given is about economic moat, where companies have these competitive advantages that is very difficult for other competitors to steal away market share from this company. And Morningstar, a financial data company, have developed a moat framework to analyze companies to see whether they have any moats in any of the 5 categories that they do have. Of course, analyzing a business moat can be a very tedious thing, and investors may like the idea but not want to put in the effort. So this is where the ETF comes in. There's an ETF called VanEck Morningstar White Moat ETF that invests in these companies that qualify to have a moat. The ticker is MOAT, right? How aptly named. And its year-to-date return is 27%, reasonably high. Net asset of $11 billion. So it's a rather sizable ETF, and that means that there are enough investors that see value in this ETF. And the total expense ratio is about 0.46%, probably higher than a plain vanilla S&P 500 SPY ETF, which is about 0.09%. But that said, its performance still able to outperform both Warren Buffett's Berkshire Hathaway as well as S&P 500 ETF despite a higher expense ratio. So you can see the blue line is the VanEck Morningstar White Moat ETF, and the red line is the S&P 500 ETF, and the yellow is representing Berkshire Hathaway share price performance. So if you started with $10,000 invested in 21.3, as of the end of 31st July, you would have $42,881 if you invested in Moat, and you will have $39,000 if you invested in S&P 500 or Berkshire Hathaway. So you can see there is outperformance over here just by applying what Warren Buffett has mentioned about the moat concept. And this is a table of numbers, right? So in terms of yearly return, in the box up area where CAGR is compound annual growth rate, the Moat ETF has grew at 14.75% per year, while S&P 500 and Berkshire Hathaway were returning sub 14% per year. Although those returns are already very impressive, right? This Moat ETF could do even better than the master himself. The second advice that Warren Buffett has always been saying is this: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So he likes to buy those higher quality businesses, better branding, have growth prospect, but just don't overpay them, right? It's okay not to buy at very cheap prices, but paying a fair price out of it is acceptable. This is also known as a growth at reasonable prices concept, or GARP, or GARP in short. And it was popularized by this fund manager called Peter Lynch in the 80s. And basically he said that, you should take the P ratio divided by the growth rate, and if the PAG ratio, this PG ratio, is less than 1, is a reasonable price to pay. So for example, let's say the P ratio is 50x. Maybe you think that it's expensive, but let's say its growth rate is 100%. So 50 divided by 100, you actually get 0.5, which is less than 1. And that means that this stock at P 50 times is still a reasonable price to pay. So the second ETF is this Invesco S&P 500 GARP ETF. The ticker is SPGP. And it didn't just use the PAG ratio, it actually has a composite ranking system. So the first step is to identify within the S&P 500 companies the top 150 based on their growth rates. And the second step is laying both a quality and a value metric to make sure that you don't overpay, right? And also to make sure that the growth is of higher quality. So that will reduce the 150 and halve it to 75. So instead of buying the entire S&P 500, they find the best 75 based on growth, quality, and value. And look at the fund details. The expense ratio is 0.33%, lower than the Moat ETF, and the fund size is smaller at 3.3 billion. To me, that is still large enough. That would not cause the ETF to just close shop, right? Because it does earn enough fees on this AUM itself. And the inception date has been since 2011. And this is the performance. Let me blow it up. And the blue line is the Invesco S&P 500 GARP ETF. The red line is the S&P 500 ETF, and the yellow line is Berkshire Hathaway. Starting with $10,000 in 2012, investing in the GARP ETF, you will end up with $56,000. While if you invested in the S&P 500 or Berkshire Hathaway, over the same period, you will get less than $50,000. So for this case, the outperformance is more stark compared to the Moat ETF. And this is the numbers in terms of yearly performance. The GARP ETF returned an impressive 16% per year, while S&P 500 and Berkshire Hathaway were returning around 14% per year. So there was an outperformance of about 2% per year on a compounding basis. So finally, we're down to the last advice. Warren Buffett talked about this concept called owner's earnings. And the reason is because he doesn't really take the net earnings based on the GAAP accounting or the GAAP accounting. So he prefer to have this owner's earnings. And owner's earnings is closest to what we call the free cash flow, right, or FCF in short. So they are not really the same, but they are probably very close together, and that is an easier way for most investors to understand. So we can actually use this FCF as a replacement to owner's earnings and develop an investment strategy out of it. So there is this ETF that focuses on that, using the free cash flow as a key element in the selection of securities. So we can see it is again a multi-stage kind of filtering process. It starts with the Russell 1000, largest 1000 companies in the US, and it has a free cash flow yield screen that reduces to 100, and then they will reallocate, right, based on their free cash flow yield amount. The highest free cash flow yield will get more allocation, while the rest with lower free cash flow yield will get lower allocation. So that is how the methodology is done, and it's quite simple. And this ETF is called Pacer US Cash Cow 100 ETF, or COWZ, or Cowz for its ticker. And the total expense ratio is closer to Moat ETF, is about 0.49%. The fund size is bigger at 14.3 billion, and the age is younger, right? It's just listed in 2016, so it's about 7 years history as compared to Moat or even the GARP ETF. Those have 10 years of history. But that said, this ETF still managed to beat S&P 500 as well as Berkshire Hathaway in this 7-year period. Starting from 2117, investing $10,000 in Cowz would give you $23,485. If you invest in S&P 500, you get $22,926, and if you in Berkshire Hathaway, you get $21,595. Looking at the numbers, the annual return of Cowz is 13.85%, and S&P 500 at 13.43%, and Berkshire Hathaway at 12.41%. So I've just introduced you 3 ETFs that have taken Warren Buffett advice and formulated into strategies and a convenient structure for any retail investors who are interested to just apply Warren Buffett's investment philosophy, right? So the first one was VanEck Morningstar Moat ETF, and the second one is Invesco S&P 500 GARP ETF, and the third one is Pacer US Cash Cow 100 ETF. So hopefully you find something that you like, and I believe that these are rather quite well diversified and suitable for long-term investing to achieve superior compounding returns. So they are definitely worth a look. Hopefully you like this video. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.